Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. All right, good morning. Welcome to the BOGART Effect. I've got Sydney Rutledge with me, and today we're going to talk a little bit about net unrealized appreciation. Some people call it NUA. This is something that we've been doing for better part of 15 to 20 years for a lot of the households that we work with. And it's hands down, in my opinion, this tax strategy, one of the most confused strategies that I still think that we work with households on. So, Sydney, thanks for the time today and looking forward to having a productive discussion.
Yes, me too. Thank you very much for having me. I'm excited to get into it today.
So to kind of frame what net unrealized appreciation is, I think it's really important to talk about the different types of accounts so that we can set the stage for what NUA is. So net unrealized appreciation, and anytime I do this talk, I always say, if there's one takeaway you have, is that this is a tax strategy. Like if that's it, victory's been made. But what NUA is it's a tax strategy that allows us to take advantage of the highly appreciated company or employer stock that's in a 401k plan and pull it out with little to no tax. So in order to do that, we need to talk about the different types of accounts of how we would move it. So to start, we talk about what are called non-qualified accounts. Some people call them brokerage accounts, but these are after-tax dollars. The benefit of a non-qualified account is that you pay capital gains taxes when you buy or sell something. There's no age restriction on when you can access your funds, so you can be under the age of 59 and a half and pull these funds out at any point in time. And you do get a lot more, let's just say, flexibility from a tax perspective. Now, there are some cons. The first big con I would say is that, again, you've got to pay capital gains taxes when you buy or sell something. So along the way, you could be paying taxes. There's taxes on dividends. But overall, I would say that these are the monies that, especially any of our households that are looking to retire before the age of 59 and a half, these are the types of accounts that we typically draw off of. So then, to talk about the next type of accounts, the next type of accounts would be qualified accounts, pre-tax accounts. This is IRAs, this is 401ks, this is 457s, 453Bs, 403Bs. But these are all pre-tax accounts. So this is where we put money in on a before-tax basis. So let's say hypothetically you make $200,000 and you put $20,000 in. That means that your taxable income now gets revised down to $180,000. So you pay tax on the $180,000. Now, the benefit is you get tax deferred growth for your entire life. So there's no tax along the way. I'd say bigger negatives is that when you go to take money out, both what you put in and the growth comes out as ordinary income. You cannot touch these accounts until the age of 59 and a half. And then when you reach the magical age of required minimum distributions, which is age 73 for anybody born prior to 1960, age 75 for anybody born after 1960. But when you reach that age, you now have to take a required amount out of these pre-tax accounts. So again, this is one of those areas where we're talking about the structuring of how the accounts are set up, but it's really one of these things where in order to talk about what net unrealized appreciation is, you have to understand the different types of accounts. So most households, when they're accumulating wealth while they're working, they're accumulating it within employer retirement plans, 401k plans typically. And so what ends up happening is they go to retire and then they fast forward and next thing you know, they've got these large pre-tax accounts that they have to start taking distributions off of. And, that's not always a bad thing. But if, let's say, for example, someone wants to retire under the age of 59 and a half, Well, if everything that they've been saving is in these 401k plans, well, we have a problem now. And so, there's lots of different reasons why this strategy can be very beneficial for lots and lots of different households. And so all of this is a long-winded way of kind of explaining NUA stands for Net Unrealized Appreciation. It's a tax strategy. And I like to affectionately say that it gives us the opportunity upon a trigger event, so retirement is one of those trigger events, to have a do-over where we can move funds from your 401k, the pre-tax world. We can pay ordinary income on the cost basis to then move the shares of your company employer stock out of the 401k and into a non-qualified after-tax account, and then have the ability to sell them at some point in the future at capital gains rates. So when I kind of set the stage and I talk about NUA as a tax strategy, I think it's important to note, when we take money out of a 401k, we pay ordinary income. So we're subject to ordinary income rates. When we take money out for NUA, we pay ordinary income on the cost basis. So what we bought those shares for, to then move them out over into a non-qualified account to then be able to sell them at capital gains rates. So really the benefit here is the difference between ordinary income rates and long-term capital gains rates. So Sydney, why don't you talk a little bit about who qualifies for NUA and how does this even become a conversation where it's something that can add value to a household?
Sure, absolutely. So you mentioned a great point about those low cost basis shares being the most advantageous when it comes to NUA. So who would benefit the most from the NUA conversation and it as a tax planning item for their household is somebody who does have a decent amount of employer stock within their pre-tax 401k plan, specifically those employees that have maybe been buying shares or company match can be part of it as well. Those shares that are at a very low cost basis. The higher cost basis shares, as long as the market value that the shares are currently trading at, anything below that is advantageous from an NUA perspective. But specifically, those employees that have been buying shares for a long time and have potentially some really low cost basis shares within that employer plan.
Yeah, and just to kind of put some numbers to this, we work a lot with companies, with employees of companies that have employer stock in their 401k. But let's say, for example, you have shares in your 401k that were bought for $15 per share, and the stock is now trading for $105. Well, that means that we have a pretty significant amount of capital appreciation, $90 worth per share of capital appreciation on each of those shares. So the point being is that if we left all of that employer stock in the pre-tax environment and just sold it and then distributed it to you, no, there's no capital gains on the sale. You'd sell it at the 105, but in order to get you the money that you need, you're going to have to pay whatever your ordinary income rate is to distribute it to you, and you're going to get the net amount. With NUA, you're going to pay ordinary income on the 15, right? That's the cost basis. Then that $90 worth of appreciation, we sell and we pay capital gains rates. So we know current tax structure on the ordinary income side now with the one big beautiful bill, we have clarity of this going forward, but ordinary income rates go from 0% to 10 to 12 to 22 to 24 to 32 to 35 to 37. Simultaneously, capital gains rates go from 0 to 15 to 18.3 to 23, 0 to 15 to 18.8 to 23.8%, dependent upon what your income is. The key point here, though, is that capital gains rates are always lower than ordinary income rates. So, mechanics of doing this a little bit, and Sydney, chime in on this, but in order to be eligible for NUA, first off, you have to have attained one of the trigger events for NUA. So the first one is you've attained the age of 55 and you are separating from service, so retiring. Another is a reset at 59 and a half. And then the last two are not so fun, but death or disability. So in most instances, when we're having this conversation, it's usually separate from service at post age 55 or 59 and a half. Now, I bring this up because it's really, really, really important if you're of the mindset that you want to retire from your company and then leave your 401k at your company provider plan. And the reason it matters is because you can leave your company, if you're under the age of 59 and a half, leave the plan there and take some distributions from the 401k for living expenses or whatever the reason is. Some employer plans have provisions that allow you to take distributions under the age of 59 and a half. And you can still be eligible for NUA once you attain the age of 59 and a half because you've now hit that new trigger, right?
Right, that's right. Each trigger has its own reset, if you will.
Correct.
Separating from service is a trigger. If that happens at 56 or 57, you decide to leave the 401k at the provider and potentially draw on it from there, kind of escaping that 10% early withdrawal penalty.
Bingo. Yeah.
The rule of 55. You can leave it there. And then when you hit that age 59 and a half, then that resets another trigger and you're able to do NUA at that point with the shares that are left in the 401k.
So, but where I'm going with this next is if you're over the age of 59 and a half and still have your company plan still have your 401k at your company provider and do distributions, you have now disallowed your ability to do NUA. So it's one of those things that we're very cautious on the timing, especially if we're talking about someone's cash flows, that in most instances, if we have NUA stock within a plan, we want to make sure that we're having a very deliberate and intentional conversation around how are we funding your paycheck, if you will, because we do not want to do something that's going to inadvertently disallow a strategy like this.
Yes. In that sense, I'll bring up an example that I had actually recently with someone that I work with. He's very fortunate that he has a really good floor of income from an annuity and like VA disability. He served in the military, so he's got a really good floor of income. Because of that, he left his 401k at the 401k provider, and he wanted to do an in-plan Roth conversion. He's 57, so he's between 55 and 59 and a half, and we're talking about he needs to do conversions from an RMD perspective, and he almost pulled the trigger on an in-plan Roth conversion. And I said, whoa. If you do that, this particular plan is considered a distribution of withdrawal, which would disallow him from doing NUA before 59 and a half. And there's a specific trigger in his mind as far as stock price goes for when he wants to pull the trigger on NUA. And he almost disallowed himself because that would be considered a distribution. And then he would have no choice but to wait until 59 and a half when that clock resets to be able to do NUA. So just be very cognizant. Every 401k has a bit different rules, but be sure to check on that, or at the very least engage your financial advisor so that you can look at the rules together so you don't accidentally mess up your distribution options.
That's a fantastic example, and really great planning work, by the way. One thing I want to add to all of, by the way, NUA is one strategy that needs to fit into a bigger financial plan, right? And what Sydney just articulated is a great example of how your advisor needs to interface on all of the other moving pieces that are happening in your life. It's not just one thing, one strategy. And that's why when I talk about NUA, it's like, this is not the silver bullet that's going to make or break anyone's retirement. This is a tax savings strategy. That's it. I've never seen someone's retirement be the ability to retire or not retire based upon any one particular tax strategy. It's all around the optimization and how do we enhance the value. One other thing I want to talk a little bit about is tax paid credit balance that's within these employer plans. So it's specifically known as the pre-1986, post-1987 tax paid credit balance. What this is it is the after-tax dollars that an employee puts within their 401k plan. Now, this is actually different than the after-tax account. A lot of our customers do get confused by this. The after-tax accounts is always going to most likely, well, I'm not going to say always, should be higher because of any growth and appreciation that has happened on the tax-paid credit balance. So the tax-paid credit balance is the, let's just say, cost basis of the after-tax account. It's specifically dollar for dollar the amount that you put into that 401k plan. Now, the reason this matters is because we actually have some clarity around what can be done with those tax paid credit balances. One is we can actually take a distribution off of it. right? You can take those monies out at any point in time. Second is you can move it to a Roth. Third is you actually can use it to apply against the cost basis of these NUA shares. So if you remember right at the beginning of the call, I said that this is a strategy where you can pull some shares out completely tax-free. Well, this is why, right? So when we talk about this tax paid credit balance, and I'm just going to use very, very basic numbers, but I mentioned that example where the stock's trading at 105, the cost basis is 15. Well, in this example, if you happen to have $15 worth of tax paid credit balance in your after tax, in the tax paid account balance, the pre-87, post-86, you're actually able to then use that $15 of tax paid to offset dollar for dollar against that cost basis. So you can pull that share out completely tax-free. So now you've got a share that's out at it's worth 105. You didn't pay anything else to get it out. And the only tax that you're going to have is on the capital gains when you sell that share at some point in the future. Now, candidly, we'd be talking about larger numbers than one share, but the point is to illustrate that we can use tax paid credit balance within the 401k plan to distribute and pull out very substantive amounts of highly appreciated employer stock and not have to pay anything in tax in order to be able to trigger that event.
Right, that's correct. Something else that's important to mention too, and you might have been going there, was that all of this has to happen at the same time,
yes.
Right? From a distribution perspective. So this gets into one of the potential disadvantages of NUA, which is that when you declare NUA, you decide that this is going to be part of your strategy. When you either call your 401k provider, sometimes there's paperwork involved depending on who custodies the 401k. This NUA declaration and distribution has to be part of the entire account coming out of that 401k provider. At the very least, I believe it's calendar year. So if you declare NUA and you do that rollover in, let's say, June, by the end of that calendar year in December, by December 31st, that entire 401k account has to be empty and has to have been rolled over.
Yeah, it's called a full lump sum distribution from the 401k.
Exactly.
And so a lot of our households get confused because they think, oh, we can just take the NUA shares out. No, unfortunately, to do this, you have to pull everything out in addition to not just the employer stock. So, let's do a real quick example of this, right? Like, let's just say, for example, an employee has, I'm going to make the number up, 5,000 shares of employer stock. Let's just say 1,000 of them are low cost basis shares. And then they've got a couple $100,000 more of non-employer stock that's invested in index funds or mutual funds, et cetera. What this is going to look like, and we kind of use in as we're doing a planning engagement for someone, we'll show them a flow chart of what this looks like. But we'll have the highly appreciated shares come out, and they're going to come out into an after-tax account. So the 1,000 shares that I just mentioned in this example will come out. Those are the highly, highly appreciated low-cost basis shares, and they'll move into that brokerage account. The remaining 4,000 shares in this example that were not highly appreciated, they might be trading closer to current market price, more recently acquired, something of that nature. They're going to move to a traditional IRA account as shares, and they stay as shares. And then everything else gets liquidated, and that comes out in the form of a check, right? So the entire amount gets distributed, but it has different funnels or channels, if you will, as to how the respective buckets are being distributed. One thing to just caution viewers on, if you happen to own employer stock that pays a dividend, be mindful of when that dividend pays, because back to Sydney's point, we have to do a full lump sum distribution here. We have to take everything out of that plan. And I've had instances where a dividend has paid back into the plan after we've already done the distribution. We thought we were done. And I'll admit we have checks and balance in place, so this isn't something that breaks on our side. But I've seen it where with other advisors that this is disallowed or triggered a taxable event because the plan was not empty at the end of the year because that dividend paid back into the 401k plan. So just something to be mindful of. Another one of the complexities of this type of strategy. But at the end of the day, it could be highly, highly accretive. Coming back to a couple of the advantages of this, a lot of times I like to use it for any of these individuals or households that are trying to retire under the age of 59 and a half. It's a very tax efficient way of generating cash flow needs in order to be able to buffer whatever that bridging mechanism needs to be. And just a reminder, the reason we keep talking about 59 and a half is there's a 10% penalty to withdraw from a 401k or IRA plan prior to the age of 59 and a half. The other reason is if you have big or lumpy purchases coming up. Like, for example, we have a lot of clients, they retire and they want to buy their vacation home. Okay, great. Well, now we're going to need a larger amount of money for that down payment, if not pay for the entire thing. And the most tax efficient way of doing that, instead of pulling, let's just say $500,000 out of a 401k plan, paying ordinary income on that entire amount, it would be to then pull the money out of these NUA shares, pay capital gains on the gain, right? Because it is more advantageous to pay capital gains taxes versus to pay capital gains taxes versus paying ordinary income taxes. The other reason is if you're very philanthropically inclined or charitably inclined, NUA shares in almost every household, especially for somebody who's had a long track record with an employer. But NUA shares in almost every household are the most highly appreciated shares. They're long term. Those are fantastic shares to donate. I always tell households that have assets, I never want to see you writing checks to charities. Don't pay cash. If you have highly appreciated positions, donate the stock. If you really want to still own the stock, then use the cash that you were going to write the check for to buy the shares back, but you're going to buy it back at current market price. And not have to deal with the capital gains appreciation. Charities don't pay taxes on capital gains, right? So I'll go back to use my example of the 105 share price with $15 a cost basis. We can give them that share. It's a $105 donation. You get the value of the 105 donation. You do not have to realize the $90 worth of capital gains. And if you really still want to own that stock, then take the $105, go buy back the stock at 105, and now your cost basis is 105. Net, same effect, right? So NUA shares are fantastic for anybody who's philanthropically inclined. Did I miss anything, Sydney?
I think you hit the nail on the head. The one other advantage that I'll kind of drive home as we wrap up here is there's two pieces of the tax savings with NUA. The first one, which we touched on a lot, is the fact that capital gains rates are always lower than ordinary income rates. And you're moving those NUA shares out of that pre-tax qualified environment to an after-tax non-qualified environment where you get the advantage of those lower capital gains rates. The other piece of the tax advantage of NUA is because you're removing the value of those shares and any future appreciation on those shares, you're removing it from that qualified pre-tax environment, which means you're saving them from being included in the RMD calculation.
Yeah. So marinate on that one real quick, because that's a very important point. For any household that is in what we call RMD prison, where your required minimum distributions are going to trigger larger required amounts, means you're going to pay more ordinary income than you want to. NUA can be a very, very, very impactful way of helping manage some of that future required minimum distribution because you're getting it out now. Right.
Right. Well, and in some cases, we're talking several $100,000 that's getting removed from, it's still your money, right? It's still your money. You can still use it as you want to, more freely, actually, because you have more control over it because it's not in a qualified environment. And you're moving that, again, potentially $200,000 over to that non-qualified environment, which effectively removes it from that R&D calculation.
And let me pull on that further, right? You're moving it out. Let's just say you retire at 55. Right, you're moving that dollar value out now at age 55. Your required minimum distribution is not going to happen for 20 years at age 75. Right, so all of that growth and compounding. Now, admittedly, there is a negative here, right? And the negative is now that these shares are in that non-qualified account. You do pay tax on the dividends as those happen. Candidly, in most of our clients' cases, they're using it for cash flow purposes once they've separated from service or retired, right? So that's not really a big deal. It's more tax efficient than ordinary income. And then the other negative is at some point, you lose the tax deferred benefit. At some point, you're going to sell those shares and you'll have to pay capital gains. Again, income and cash flow needs, like it trumps everything. But in full disclosure, it is technically still a disadvantage. You know, a couple other things I would say just while we're on the disadvantage side, it is also a tendency that when we do these NUA strategies that it does tend to lead people to maintain a concentrated position in employer stock when may or may not be appropriate. If I look at like how some of these stock prices have performed over the last couple of years, it's like they've had a good year, and then they're flat. You know, the tech companies have been phenomenal, right? Any of the employer stock that's sitting in the tech 401k plans, like NUA is a highly accretive, highly beneficial strategy. However, do you want to maintain that exposure, especially in a concentrated manner for a long period of time? I don't know. That's a conversation to have with your advisor, right? But the point is that it does tend to lead people to maintaining concentrated positions more than they probably should post some type of life event, retirement, et cetera. What other disadvantages, Sydney?
There's no benefit. The one that comes to mind for me is there's no benefit of future tax deferral on the growth. If it was in that kind of pre-tax environment, you would continue to get that tax deferred growth. Yep. If you pull it out into a non-qualified account, you are that tax deferral kind of goes away.
The other piece that comes to mind is a very active conversation around how NUA integrates for estate planning purposes. And this is one that I think a lot of individuals get confused by. But estate planning is one of those things where I think a lot of individuals who own assets and brokerage accounts, when they pass away, their advisors maybe are uninformed of what NUA is, or maybe just do not understand the nuances of NUA. But a lot of times when someone inherits stocks that's in a brokerage account, they immediately step up the cost basis to the value as of the date of death. And so the reason I'm bringing it up is it is a little bit of a disadvantage in the sense of we need to track what those NUA shares were, because ultimately the way that the law is written for NUA is that the NUA portion still has to pay capital gains tax upon your passing. The appreciation post date of NUA, that's what's eligible for step up in cost basis. So I'm going to keep using my example of the $15 cost basis with the 105 stock. So there's $90 of NUA share of NUA value, capital gains tax value. Let's say we execute the stocks at 105. Let's say when you pass away, the stock is now, let me just say 200, right? So you've got now another $95 of appreciation post the execution of NUA. Well, what a lot of times happens in practice is the advisor who's on the account or the custodian, they don't necessarily understand or know what NUA is, and they immediately will move the cost basis up to 200, and that's actually incorrect. The cost basis needs to actually be set at 110 because we cannot completely escape the NUA portion of the tax. So just something to be mindful of as you're building your estate plan out. If you're working with an advisor who's not familiar with NUA, I would make sure that you integrate something that does annotate that there is NUA stock within the portfolio, just to make sure that you're covered. At the end of the day, I personally don't want to be in trouble with the IRS. I think that's not a good place to be in. I don't think you would want your children to have to deal with that either. It's something that you just very simple to have integrated into an estate plan and make sure that it's there. No big deal. What else today, Sydney?
I think we've really kind of broadly defined the scope of NUA here. We talked about the advantages and the disadvantages, really drilled home exactly your point at the beginning, which is that this is a tax strategy. It's never going to be a very, very material decision for someone's retirement, to retire or not to retire. I've never seen it make that big of an impact in someone's individual plan, but there's definitely some room for tax optimization. So it's something to look at. If you are an employer, you participate in your employer plan and you've got a large position of stock potentially with low cost basis, this is definitely a strategy that needs to be on your radar for when you want to retire, specifically if you are looking to retire pre-59 and a half.
I would say this is something that you can never not look at this early enough, right? Even if you're in your early 50s, late 40s, and it needs to be factored into a plan, and I would argue that Bogart Wealth is probably one of the paramount names with regards to net unrealized appreciation, and we're at a minimum happy to do a free financial plan for you if you're at an employer that has highly appreciated stock. We have proprietary tools that we've built out to be able to help with this analysis and translate some of the decisions that need to be made along the way. And again, there's absolutely no cost, absolutely no obligation. Sydney, I know you're going to be doing a presentation on this in a couple weeks. Looking forward to seeing that as well. So this is a nice little, let's just say, conversation piece to complement your presentation in a couple weeks. So looking forward to that. Thanks for the time this morning.
Thank you so much.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.